Did you know that 90% of investors suffer significant losses due to poor risk management? Yes, you heard it right. A staggering 9 out of 10 investors face substantial setbacks because they overlook this vital aspect of investing. Imagine sailing a ship without a compass or driving a car without a roadmap. That's exactly what investing without risk management is like. It's a journey full of uncertainties, with potential pitfalls lurking at every corner. These pitfalls can be anything from market volatility to economic downturns, and without a robust risk management strategy in place, they can wreak havoc on your investment portfolio. This doesn't mean that investing is a dangerous game, far from it. Investing is a calculated risk, and like all risks, it can be managed. But fear not, with the right strategies, you can navigate the investment world with a lot less risk. Risk management might sound complex, but it's actually quite simple when you break it down. Let's start with diversification. Think of it as not putting all your eggs in one basket. Instead of investing all your money in a single stock or bond, you spread it across a variety of assets. This way, if one investment doesn't perform well, others might, balancing out the overall performance of your portfolio. Diversification is about creating a safety net for your investments, reducing the impact of any one asset's downturn. Next up, we have asset allocation. This strategy involves dividing your investment portfolio into different asset classes, such as stocks, bonds, and cash. Each asset class has its own level of risk and return potential, so it's about finding the right mix that aligns with your investment goals and risk tolerance. It's like cooking a perfect meal. You need the right ingredients in the right proportions to make it just right. Then there's regular portfolio review. Just as you would regularly check your car's oil or your home's roof, you should also periodically review your investment portfolio. This helps you ensure that your asset allocation still aligns with your goals and that your portfolio is still diversified. It's about keeping your finger on the pulse of your investments and making adjustments as necessary. And finally, let's not forget about hedging. This strategy involves making an investment specifically to offset potential losses in another. It's like buying insurance for your investments. It doesn't prevent a mishap, but it can help cushion the fall if one happens. These strategies are not about eliminating risk completely. Let's face it, investing always involves some degree of risk, but these techniques help you manage it effectively, allowing you to navigate through the turbulent waters of the investment world with more confidence and less anxiety. Remember, risk management is not about avoiding risks. It's about understanding them and knowing how to handle them. Now that we've broken down these strategies, let's talk about how to implement them. First, for diversification, consider spreading your investments across different asset classes. This could mean investing in a mix of equities, bonds, commodities, and real estate. By doing so, you're not putting all your eggs in one basket, and you're potentially reducing the impact of a poor-performing asset on your overall portfolio. Next, asset allocation is all about having a balanced mix of assets. You might want to consider your age, income level, financial goals, and risk tolerance when deciding on your asset allocation. For example, younger investors might opt for a higher proportion of equities for potentially higher returns, while older investors might choose more bonds for stability. Lastly, regular portfolio reviews are crucial. Keep an eye on your investments, track their performance, and make adjustments as needed. This could mean rebalancing your asset allocation or exiting underperforming investments. With these strategies in your toolkit, you're well on your way to becoming a more savvy investor. Let's quickly recap the key points we've discussed today. We started by understanding that investment risks are a reality, and they're not always negative. It's the uncertainty that gets to us. But with the right strategies, we can mitigate these risks. We broke down some effective risk management strategies such as diversification, which helps spread the risk across various investments. We also discussed asset allocation, which involves balancing high-risk and low-risk investments based on your risk tolerance and financial goals. And then there's regular portfolio review, which keeps you updated on the performance of your investments. We also emphasize the importance of implementing these strategies. Understanding is one thing, but taking action is what truly counts. So, start small, be consistent, and over time, you'll see the benefits. Remember, the goal is not to eliminate risk, but to manage it effectively. And with these strategies, you can do just that.